No one likes paying taxes, but if you own investment real estate, there's a way that you can get out of paying some of your taxes legally the rest of your life. Hi, I'm Rebecca. Thank you for joining me on the Mama Lorian Way, where I'm a mom learning how to build wealth for her family, working towards financial freedom through investing and entrepreneurship. Today, I want to give you some numbers on a really powerful tax strategy that can help grow your wealth exponentially. This is super powerful, but I have to make a disclaimer. I am not a CPA. This is not tax advice, not financial advice. It's just education. Always consult a professional. So before I start, one thing I want to say is the U.S. government, and this is for the United States, makes tax laws to encourage certain behaviors. For example, like you get a deduction if you make a donation to a charity because the government wants people to donate to charities. There's a powerful tax strategy called the 1031 exchange, and it encourages real estate investors to keep their money invested in real estate under the idea that the more we invest in real estate, the more the economy boosts and the better off we all are. So I want to talk about how powerful 1031 exchange can be for you, the taxpayer. So first of all, what is a 1031? Say you have a rental property and it's like a house and you bought it for $200,000, you sell it for $400,000. That's a $200,000 capital gains that you would have to pay taxes on if you didn't do a 1031 exchange. If you elected to do a 1031 exchange with all the rules and regulations about it, you could take that total amount of profit, defer taxes on it, use the entire capital to reinvest in a similar or higher value kind of property, another real estate investment, and continue to build your growth with more capital. You could rinse and repeat, sell that property, keep all the profits, continue deferring your taxes until you die, right? And just leave it for your heirs. No, it's even crazier. When you die, your heirs are not liable for all the deferred taxes. What's called a cost basis resets the year you die, and they would just have to pay taxes on any gains it incurs after the year of your death. I know, it's like, is that legal? Yeah, it is. Still, always talk to your CPA. There's tons of very specific rules around it, which I'm not going to get into. All I want to show you now is the numbers about how powerful this can be. So I'm going to go to my screen. Here we are. So I'm going to go through some numbers. Just bear with me, but I found out how powerful this was when I was preparing this video. I'm going to go through the numbers. There's a lot of numbers here. I'm making certain assumptions, but just as an illustration of how powerful this strategy can be. First scenario, we're going to say we're paying taxes. Say you have a rental house. You have a profit of $100,000. I'm going to assume 20% capital gains. So you'd pay $20,000 in taxes for a total receipt of $80,000. Take that $80,000, reinvest it like in a multifamily syndicate for 5 years at 20%, making certain assumptions, have $160,000 at the end of that. Oh, but we got to pay some taxes. 20% taxes, paying $16,000 in taxes. So we'd come away with $144,000. One invest that $144,000, 5 years at 20%, assuming certain things, $288,000. Oh, but there's still taxes. You pay another $29,000 in taxes, and after 10 years, you'd have $259,000 and some change available to invest. Now, granted, you could take it out, put it in your pocket, do whatever, but this is what you'd have at the end of those 10 years. Scenario number 2, 1031 exchange, no taxes. First sale, take $100,000 in profit, 0 taxes. You keep that $100,000, reinvest it. The same 5 years at 20%. Come away after 5 years, $200,000. Pay no taxes. Take that $200,000, invest it again. Same 5 years, 20%, $400,000. Pay 0 taxes. After 10 years, you would have $400,000 to reinvest into another property. You can see where this is going. I just went to side by side. So the first sale would come away equal. We start off on equal ground. Paying taxes it decreases 100,000 to 80,000, 200,000 to 144,000, 400,000 to 259,000. So the difference when you're paying $20,000 in taxes, that's like a car payment. That's like a car. You can buy a car for $20,000. Next time you have to pay taxes, you're paying $16,000. That's like a car for your teenager. The next time you've got some more gains, $28,000. Now you're paying for a new car to replace your first car. After 10 years side by side, $400,000 versus $259,000. It's a difference in 10 years of $140,000. That's a really nice Tesla. That's a house for some people. 15-year difference. This is definitely a house. $333,000 if you continue the cycle with those stipulations. 20-year difference. This is what is staggering for me. $760,000. This is $760,000 that you could leave in your estate made from $100,000. And then your heirs don't even have to pay taxes on it. That's powerful. That's legal. However, again, so many rules around this. You have to talk to professionals that do 1031 exchanges. It always has to be real estate for real estate. And once you take it out, you are going to be paying taxes for it. But it's a very interesting way if you wanted to start with one piece of property and create a legacy for your kids that they can enjoy tax-free. All right, I'm Rebecca. Thanks for joining me. Like, subscribe, and I will catch you on the next one.